Good morning. This is Horizon's Middle East and Africa, our top stories this morning. China's world-beating equity rally loses momentum after the nation's top economic planner fails to deliver fresh stimulus measures. Sirens sound in Tel Aviv. Israel says it has intercepted most of a barrage of rockets fired by Hamas on Monday as fighting escalates on multiple fronts a year into the war. And Kenya's central bank is widely expected to cut its key interest rate for a second straight meeting today, aided by cooling inflation and the Federal Reserve's easing stance. Well, it's just gone 8 a.m. across the Emirates. I'm Jemana Versace in Dubai. As ever, let's get you up to speed on how these markets are faring. We saw a bit of a dip yesterday for Wall Street. Both the S&P and the Nasdaq seeing declines by the end of the session. We saw some of those key tech names, the likes of Alphabet, Tesla, all end lower on the session. And as you can see today, we are trading sideways. But of course, most of the action has happened in the Asian market session. We're going to get to that in just a moment. 10-year yields, big psychological level, you could say, back up towards 4%. We've sort of moved back to the mantra of good news is good news, I would think, for the bond market. Ever since that non-farm payroll number came in higher than expectations, what we have seen is yields steadily climb higher and higher, sort of moving away from this soft landing scenario to what some people are calling a no landing scenario. So that's a big theme for U.S. investors. Brent clearly still very much in focus. And what we saw yesterday is we actually ticked through $80. We're up about 12% since Iran fired those almost 200 ballistic missiles towards Israel. Ever since then, oil has been very supported. Just overnight, though, we are slipping about 1.5%, namely because of the price action in China. I keep alluding to it. We will get there in a moment. And then iron ore, you can see some of the major industrial metals also slipping in the overnight session as well. The likes of copper, nickel, iron ore, all of these China-heavy metals have dropped 1 to 2% in the overnight session. Switching over, I also just want to flag to you VIX, the VIX index, also on our radar as well. And even though the U.S. stock markets are trading close to all-time highs, we are seeing increasing amount of volatility getting priced into these markets. Of course, very far away from where we got to back in August when we had that big VAR squeeze. But what we are seeing for the VIX is it is steadily climbing higher as investors account for more volatility to come in the months ahead. But speaking of volatility, let's get to an extremely volatile market session to check in on how markets in Asia are faring. David, just give us the latest. What exactly happened in this Asian market session today?
Yeah, I mean, there were many elements at work, and I think I'd like to just start maybe by just giving our viewers a bit of a brief look, underneath the hood. Our email back and forth earlier on, and you effectively ended that conversation by saying good luck going into the open today, just to underscore how hotly anticipated this reopen was in China after a week-long holiday. So I think a couple of things, right? First is there is an element of catch-up because mainland markets have been shut for over a week. There is this massive adjustment higher, was at the open of about 11%. We've since pared back 6% going into the lunch break. We're on the lunch break right now. Volume substantially heavy, 350 to 400%. In terms of market breadth, and change the page, please, a substantial amount of this index is trading higher. So about 5,000 stocks overall, 95% are trading higher. So that's the sort of big picture view. When you look at sector outperformance, it does give you an indication that a lot of the moves today were mechanical in the catch-up because a lot of the premium and the gap between A and H shares, I'm getting into inside baseball here, a lot of the constituents are in the IT space and brokers, for example. That's where you're getting the bulk of the gains, not so much in the cyclicals. And that takes us into the final page. Flip the page, please. Some level of disappointment because we did have that NDRC, that's the economic planner briefing in Beijing taking place, and somewhat really, I guess, expectations in the market were somewhat elevated after, that briefing a few weeks back where you did have the sort of big bazooka coming out of monetary officials. Not the same extent that we got today. So there was an element of profit taking in Hong Kong, down about 6%, although market turnover, as you can see, I'll leave you with that, still possibly on track for a record day in Hong Kong. What happened here effectively dragged down the rest of the region, down the most at this point, Jemana, in about 2 months or so.
Yeah, well, David, thank you for giving our viewers insight into some of the background conversations that you and I have before the show. But look, I do want to ask you, because I'm not as into the weeds as you are, but on a day like this, you come in, and obviously these Chinese markets have been on holiday for a while now. They are playing catch-up. So CSI is still positive. It is mechanical, as you flagged. But then the Hang Seng Index is down, almost 6% today. Looking ahead, what is going to be the biggest indicator for markets moving forwards? The fact that CSI came back and it's up a significant amount, or on this day, Hang Seng Index is leading the declines and is down quite substantially?
Well, I would say look at the Hang Seng Index simply because that is, for example, a proxy of where the foreign money coming in. For this rally to sustain itself, the incremental buyer has been the buyer so far that's stepped away and not yet dipped their foot back in a big way into this market, and that's the dollar investor out there. In terms of catalyst, what could sort of bridge that conceptual gap between your long-only funds back into this market, we really need to hear the fiscal measures come through from authorities. We've heard so far from the PBOC and monetary officials. We heard today from economic planners in terms of the details of how they're implementing your existing plans. What we haven't heard so far are the incremental plans on the fiscal side that really gets this economy going.
Yeah, and that press conference seems like it was a catalyst for further disappointment in the market as well, those who are looking out for further demand stimulus measures. David, as ever, great to have you on our show, and thank you for bringing us the update on what has been a very volatile Asian market session. Hamas fired a barrage of rockets towards Tel Aviv on Monday, 1 year after the Gaza militant group launched its attacks on Israel. Sirens sounded across central Israel, but the military says it intercepted most of the rockets. Meanwhile, officials also say Hezbollah fired 135 rockets at northern Israel on Monday. Israel sent troops back into northern Gaza at the weekend, but it also wages a ground and air offensive against Hezbollah across its northern border with Lebanon. So much going on. For more, let's bring in Bloomberg's executive editor for the Middle East, North Africa and Russia, Stuart Livingstone-Wallace. Perhaps it wasn't a coincidence that these rockets were fired into Tel Aviv on October 7. You had Hamas show defiance by firing those rockets, most of them intercepted into Tel Aviv. But then you also had what the IDF say was around 135 rockets fired from Hezbollah into northern Haifa as well, and not all of those were intercepted. So it really shows that even though these militant groups are down, they're not out.
No, and the one that should be of concern is Hamas. So they've been absolutely hammering Gaza now for a year. They've had troops on the ground, they've had strikes, they have quite extraordinary surveillance. And yet, these areas that they keep saying we've cleared them, the Hamas units pop up again, the rockets get fired, the insurgency continues. And that should be a concern going forward, that even with all that firepower, they're finding it very, very difficult to contain Gaza permanently. And so I think that's a good reminder. The last couple of weeks, the narrative has swung. So we saw in the north, that is, in terms of the pager attacks, the walkie-talkies, taking out the leadership, particularly Nasrallah, but many others as well. And that sort of reinstated Israel's role as having absolute supremacy on the battlefield. But again, all of these attacks coming in from Gaza are a reminder that there are weak points. This is far, far from over. Yeah,
and just to that point, Israel is warning citizens in southern Lebanon to evacuate or stay clear of coastal areas. How should we read that?
Yeah, I mean, again, it feels like an expansion of the existing campaign. So, yes, it's a continuation, but you just think about the situation on the ground. Yes, most of the strikes have gone into southern Beirut, the Hezbollah stronghold, the Bekaa Valley. We obviously did see that bombardment of the link between Lebanon and Syria, and that is concerning given the number of people that are trying to get out of the country. And now if you have some sort of naval operation going on to the west, that again, it just sort of speaks to almost this encirclement that's going on, and obviously a desperate situation for many of the people in the population, but again, a signal that this has some ways to go.
Yeah, the intensification continues 1 year on from October 7th. Stuart, thank you so much for bringing us the latest. Stuart Livingstone-Wallace, Bloomberg's executive editor for Middle East, North Africa and Russia. Now let's bring in Middle East strategic analyst Avi Melamed. He is a former Israeli intelligence official, the founder and CEO of Inside the Middle East Intelligence Perspectives. Avi, given that it is just 1 year on since October 7, I actually just want to start off asking you a question about that day in itself. Clearly a very traumatic day for Israel, a very sad day, one of tragedy, but then equally a big intelligence failure. To what extent do you think that served as a catalyst for a rethink of how Israel thinks about not just its defense, but also its intelligence?
Thank you for having me. Indeed, there is a lot of need to rethink many of the concepts and the guiding lines that have been guiding the Israeli both intelligence, security, and policy makers, particularly following, of course, October 7th. There has been a significant failure. I would say that one of the most significant ramifications following that is we should expect that from now onwards, Israel will be much less reluctant to act proactively to intercept military and terror threats around its borders.
Speaking of that, of course, the whole region is on high alert, waiting to see how Israel is going to respond to those Iranian ballistic missiles that were sent towards Israel about 5 days ago. And there are many options being put on the table. What, in your view, is going to be the most likely response out of Israel? What are they likely to target?
I think Israel is mostly likely to target military legitimate targets that are mostly associated with the Islamic Revolutionary Guards, the IRGC. We're talking about apparently depots of missiles, factories that are related to their military industry, facilities and infrastructure that are connected to those military capacities and others. I don't think that Israel is going to attack the nuclear sites. And I'm not so sure about the oil infrastructure in Iran, though I would not totally rule that out.
Why would you think that Israel would not go ahead and target nuclear infrastructure? And of course, I mean, nobody's privy to what the conversations that are going on there, but why would they stay clear of it, to your mind?
I think there are a couple of reasons. First, I think it's very clear that the United States wouldn't like to see something like that, and Israel has to be very tuned to the interest of the United States. I think there is another reason. Israel wants to, on the one hand, to demonstrate very clearly and across the Middle East, and that's exactly, I think, what's going to happen, that if you attack Israel with hundreds of ballistic missiles, you should expect severe ramifications. On the other hand, I think that Israel would like to try as much as possible to leave the Iranian regime space to maneuvering to avoid a counter-reaction and thus to avoid further escalation. I think these are the two major calculations that are guiding the Israeli policymakers on that issue.
Mm-hmm. Is it fair to say then, and I don't want to put words in your mouth, but that the Israeli reprisal this time around will be just another manifestation of this mantra of escalating to de-escalate?
In a way, you could look at it this way, but I think that we have to look at the big picture, and the most significant picture is this one. This war that Israel is now fighting in different arenas basically manifests the threat that the mullah regime is presenting not only to Israel, but also to the region and to the world. As a reminder, Houthis, one of the proxies of the Iranians, are constantly attacking global trade, maritime trade in the Red Sea and the Bab el-Mandeb Strait. This should be a pivotal moment for Western powers once and for all to proactively and decisively move, and once and for all to end or restrain or limit the mullah regime aggression. If they are not going to do it today, the challenge is going to be by far much more significant tomorrow.
Yeah. Avi, what do you think Israel's objective is in Lebanon? Of course, the stated war objective is to return security to the northern border so that residents can return home. But at what point in this conflict will Israel have deemed that war objective to be complete and Hezbollah sufficiently decapitated?
It's not about eliminating Hezbollah. It's, as you said, basically to make sure that there are conditions that will secure the return of Israelis that have become refugees because of Hezbollah's attack. We are looking at some 60,000, 70,000 Israelis that could go back to live in their communities along the Israeli-Lebanese border. Remind you all that there are two Security Council resolution 1559 and 1709 that called clearly for the deployment of the Lebanese army along the Israeli-Lebanese border, the disarmament of Hezbollah, and the deployment of Hezbollah north of the Litani rivers. So I think that those are the major objectives that in the end of the day should be implemented on the ground. Again, these are the Security Council, the United Nations Security Council resolutions, and they have to be followed. As far as Israel is concerned, first and foremost is the need to make sure that Israeli citizens could go and live safely in their communities along the Israeli-Lebanese border, and there should be no further threat from Hezbollah in proximity to the Israeli-Lebanese border.
Yeah. Avi, thank you for staying up late to speak with us. We really appreciate it. Avi Melamed, former Israeli intelligence official and author, founder and CEO of Inside the Middle East Intelligence Perspectives. Thank you. Well, still ahead, we are going to go back to talking about markets, more on China's world-beating stock rally, losing steam after a key government briefing underwhelms investors. Analysis with Hon Hai from Saxo Bank next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jemana Versace in Dubai. While traders continue to reprice the Fed's policy path for this year and next, St. Louis Fed President Alberto Musalem says he supported the jumbo rate cut last month, but is warning against easing too quickly. So let's bring in Hon Hai, Chief Macro Strategist at Saxo Bank, to piece together all of the bits of news that we've had driving markets the last few days. Maybe let's just start, though, with the price action that we've had in Asian markets overnight. It was quite a volatile session. I don't know if you saw my colleague David earlier describing what went on. Yeah. Obviously, Chinese markets back from holiday, CSI playing catch-up, but a really big drop for the Hang Seng index here. And it seems to be some disappointment coming through because of a lack of further stimulus. Is that what this market needs to keep moving higher? More and more stimulus being put forward by the authorities?
It really does, because when you look at the raft of measures that were introduced coming into this long Golden Week holiday, a lot of it was around sort of easing credit. So lower rates, looking at the mortgage market, and sort of promising some kind of support for the stock market, which is why I've seen such a profound reaction in the stock market. But to really get the economy going again when you're in a balance sheet recession, let's look at the Japanese experience, let's look at what has happened since the global financial crisis. You need to print money, you need fiscal stimulus, not just the credit side. And China is going through a balance sheet recession. So we need this big fiscal announcement. Everyone's going to be asking where it is. So I think to get a new leg higher, to get a new sense of energy, we're going to see something more dramatic in the fiscal outlay, the willing to deficit spend by the Chinese government. But
valuations matter, right? Like, we're looking at U.S. stock markets close to all-time highs once again. Valuations a lot richer than they were even going into last earnings season. Earnings growth expectations moderating. And then you look at these Chinese markets, for most of the year, they got beaten down. Obviously, we've seen a massive rally in the last week. But from a pure valuation perspective, isn't there more potential upside owning Chinese equities here than U.S. equities?
Well, you would think so, given, like you said, with the valuations. But I think people want to see a bright story. They want to see an investable market, a liquid market where there's this potential for real growth. And the question is, so they can do fiscal stimulus, but will it be productive spending? And that is a big question mark I would have. I think the consumption side of the Chinese economy, that's long been the focus, this switch to less on the manufacturing and production side and more into consumption. That's still lacking, so there are a lot of question marks still.
So how are you reading the signals coming through on the U.S. economy? We've moved from hard landing to soft landing, and now people are saying no landing. So where are we?
Well,
pretty fickle.
It's really difficult. You're sort of caught between the two scenarios, the soft landing or no landing, and are we just sort of winding slowly towards some sort of growth slowdown and maybe even a recession risk next year? And I don't think anybody really has a handle on it. So we need to see some more months of data to get a sense of where this economy is. You could argue we're simply sort of rebalancing or readjusting from the crazy levels of lack of slack in the labor market and everything we had in the post-pandemic rush of hiring. And there just wasn't enough capacity in the economy given the amount of stimulus. Maybe we've just normalized, and maybe we're just going to be coasting for a while. So I think that seems to be the sort of the near-term situation. I think there are significant parts of the economy, however, that are suffering, the interest rate sensitive.
I mean, I just wonder, so already you've got interest rate cuts being priced out of the market, but still it doesn't seem to influence where stock markets go. And I've come to the conclusion that whether it's a soft landing or a no landing, it doesn't really matter for stock market's trajectory because, as long as growth is not negative, then the fundamentals still support equities rising.
Soft land, the two scenarios that would be an upset for this market would be a sort of a retightening need. So suddenly the need to say that inflation is rising again and there's going to be no further cuts. That would be on the one side. And the other side would be, of course, as you mentioned, an actual growth slowdown, an actual recession. The market is not ready for either of those two scenarios. It's sort of hoping for this sort of magic Goldilocks soft or no landing scenario.
Yeah. Final question, just to round things up. Do you think the dollar stays strong, or will we continue to weaken given the market has started to price in this easier rate cutting cycle?
Well, I think the dollar stays relatively firm as long as the rate outlook stays firm, or if we get a really ugly recession. So it needs this sort of a very soft landing. And more Fed rate cuts to continue to weaken.
Yeah. Well, one of the currency pairs that we're watching very closely is dollar yen, and that seems to be totally at the whim of what the greenback is doing as opposed to the yen at this point.
Yes, and U.S. yields as well.
Yeah. John, a pleasure to chat to you. Thanks so much for coming on our show. John Hardy, Chief Macro Strategist from Saxo Bank. Well, coming up, China's world-beating equity rally loses momentum. We're going to be talking more about what's been happening with the Asian markets with Winnie Wu from Bank of America Global Research at 8:30 a.m. Dubai time. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Libya's oil production climbed above 1 million barrels a day for the first time in 2 months. It follows the resolution of a political standoff in the OPEC nation that had curbed output and exports. The higher output will add supply to an oil market that's already struggling with soft demand. Saudi Arabia is said to be preparing to make a multi-billion-dollar bet on hydrogen. Sources say the kingdom's sovereign wealth fund will launch a new company to produce the much-hyped low-carbon fuel. It expects the firm to invest at least $10 billion, which could grow significantly depending on demand. And Saudi Arabia's public investment fund is set to become a minority partner in department store chain Selfridges. That's after it bought out the position of the now insolvent Signa Group. Bloomberg understands the PIF will take a 40% stake in both the properties and the operating businesses of Selfridges. And a quick look at futures before we head out. It has been quite a volatile session for markets overnight with these Asian equities slipping somewhat. The Hang Seng down about 5-6%. Coming up, we will be talking more about the outlook for equity markets as this stock rally fizzles, with traders reassessing stimulus bets. Bank of America Global Research joins us next. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. China's world-beating equity rally loses momentum after the nation's top economic planner fails to deliver fresh stimulus measures. Sirens sound in Tel Aviv. Israel says it intercepted most of a barrage of rockets fired by Hamas on Monday as fighting escalates on multiple fronts a year into the war. And we'll be live in Taipei, where the world's biggest iPhone assembler is now looking to AI and electric vehicles for growth. It has just gone 8:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Well, we saw a bit of a pullback yesterday for Wall Street with the S&P and NASDAQ seeing some losses by the end of the day, down about 1%. Some of the big names in the NASDAQ index leading the declines. But, of course, the market is still digesting the stronger payrolls print that came through on Friday. Looking ahead to the CPI print, again, will be a big signal for direction from here on Thursday. Today, futures are not doing much, leaning sideways, though 10-year yield sitting at 4%. That that was a big level for the markets yesterday, one of those key psychological levels. We are about 2 basis points firmer on the session, but still we moved up about 6-7 basis points as, again, the market sort of factored in the possibility of no landing at all for the U.S. economy, and the signals coming through still pretty strong from a fundamental perspective. Brent in focus, just sitting below $80 now. We are down 1.5% overnight, but we got as high as through $81 in the session yesterday. All of that on back of further geopolitical premium being priced into the space, certainly not fundamentals. And if you look at, again, the drivers coming through from China this morning, explains why we are sitting on the back foot today, down 1.5%. And then also a quick look at some of the key metals, industrial metals that we talk about in the context of China's old economy. Today, iron ore is down 1%. Copper, nickel, also seeing some declines this morning as well. But just quickly on oil, I was talking about the geopolitical premium priced in to the energy complex. Take a look at how much oil has climbed just in the last week since that Iran ballistic missile attack on Israel. We are up about 12% over the course of the last 5 days. Quite significant. It was only a week ago we were trading close to a 70 handle. Now we're sitting at an 80 handle. Clearly does tell you that the market is very much focused on the developments in this particular region. But let's talk more about some of the volatility that has come through from these Asian markets. David Inglis joins us now from Hong Kong. So Chinese markets back from holiday. We saw a bit of a catch-up trade for CSI, but it's not a pretty picture elsewhere.
No, not at all. In fact, almost the mirror image of what the CSI 300 is doing is where we are here in Hong Kong. We're down about 5 or 6%, and that's pulling down effectively the entire tide across the region. Where we did get some catch-up, though, to your point, is really on price in the CSI 300. We opened up 11%. As you can see at the break, we're up 6%. It's really, though, in volumes and turnover and market breadth where, at least if you look underneath the hood, where you are seeing markets play catch-up. In fact, on that note, since you mentioned oil prices in Shanghai are up 10%, a case in point. Now, the rest of the region, though, and I think Hong Kong is a very good example of this, we did hit fairly extreme levels in momentum, which is why, I guess, for one, you do see a paring back as far as some of the price is concerned. I'll get to valuations in a moment. Market breadth, we talked about 95% of the over 5,000 stocks onshore are trading higher. Small caps, as you can see, are still doing very well. I think the question right now as it pertains to China, and as you look at the next page, which is valuations, was whether or not expectations should have been this high ahead of an economic planner, a body that's more descriptive and implementation focused more than prescriptive, and a body that is able to come up with or announce new stimulus. That said, this major reset in markets and price, 30-40% from the bottom 3-4 weeks ago, have effectively taken valuations now to back around the 10-year average for most. And the question right now is, what's next?
Yeah. Very fair. Very fair. Well, if today's volatility is anything to go by, we're going to be in for a wild ride. David, thank you so much for the latest. David Inglis in Hong Kong. Well, China does remain confident in reaching its economic targets this year, although it held back from announcing more major stimulus. Let's bring in China correspondent Min Lau, who joins us from Hong Kong. Well, there were quite big expectations going into this press conference by the NDRC. They're called the National Development and Reform Commission, that further stimulus measures were going to be announced. But it seems as though what they did announce was underwhelming. Tell us how.
Yeah, well, the title of this briefing was Implementation of Incremental Economic Policy. So I guess you could tell that it wasn't going to be the huge big bang stimulus that people were hoping for. As David mentioned, the NDRC actually doesn't have the mandate to increase fiscal budget deficit without the legislature approving it first. So perhaps a more appropriate timing for the sort of big bang stimulus that we're looking for would be maybe at the end of the month in October when the NPC Standing Committee is going to meet. But at today's press briefing, though, we got some more details about some of the measures to boost consumption, for instance, to increase income among the lower middle income group, providing subsidies for new graduates, for example, and extending loans to mid-sized enterprises. The officials also urged the quickening of fiscal spending, calling on local governments to complete the issuance of local government special bonds by the end of October. Now, 90% of those bonds have already been issued by end September, but this is in interesting because it could potentially open up a space at the end of the year for the government maybe to announce a new bond issuance if authorities are so inclined. The officials today also announced that they will bring forward 100 billion yuan in investments that was planned or budgeted for next year. They're bringing that forward to this year. They're also going to continue to issue ultra-long sovereign bonds, although no details on the size of that. So markets seems a little bit disappointed. If you look at the major gauges, they have all pared back gains by about half since the opening trade this morning. But some analysts are warning that, don't get too bearish because we still have more opportunities for the government to announce bigger fiscal stimulus, perhaps in the fourth quarter.
And also perhaps just a technical adjustment. We've traveled a long way in a very short space of time. Bloomberg's China correspondent, Min Lau, thank you. Well, let's continue the conversation further, bringing in now Winnie Wu, the Chief China Equity Strategist at Bank of America Global Research. Winnie, good to have you on the show with us. Let me just start off by asking you whether you think Chinese authorities have done enough to support the Chinese equity markets in the short term.
I think in terms of supporting equity market, judging from a result perspective, various China indices went up 20 to 40% within a few days. So, in terms of stimulating the stock market confidence, it was very successful to the extent that some market commentators were already worrying about too much a liquidity-driven bubble, which could end up in bubble burst. So I think, enough focus is being placed on the stock market.
Yeah. One of the criticisms being leveled at the stimulus package that was introduced last week was that it was a whole raft of supply-side measures and not so much a lot on the demand front. So, yes, a lot of liquidity to the system, a lot of easing of some of these housing requirements. But if the demand is not there, then you're not necessarily going to see the economic pickup to go along with it. Is that what is needed in order for the market to believe that this is actually going to have a tangible impact on the real economy, not just on stock markets?
Right. Apparently addressing the issues in the real economy is much more challenging and takes much longer time. So we think, equity market has a very positive initial response to the policy pivoting, but investors also need to be patient in terms of, understanding that whether it's the reforms or, fiscal package or whether it's the resulted impact on the economy and corporate earnings, those will take much longer time to happen. So managing expectations, be patient, and at this level, as we seen earlier, valuations already back to the long-term average levels. I think the buy everything China stage is probably going to be over very soon. If it's not already over, investors need to be more selective and manage their expectations.
Yeah, so let me ask you about that, because the sectors that have done well are consumer discretionary. Obviously, property, we're seeing a bit of a bounce there coming off extremely low levels.
Yeah.
Healthcare.
Yeah.
Do you think that those sectors are going to be the sectors that will lead the gains looking ahead?
I think what we saw in the past couple of weeks is massive rotation, right? People earlier this year were mostly positioned in the defensive sectors, high-yield stocks, SOEs, energy, banks, and telecom utilities. But with the policy pivoting, expectation on growth certainly gets a lot better. And the hope is that the stimulus will mainly be focusing on the consumption side and on the property side. So, those under-owned property, consumer, and some healthcare stocks, which were trading at lower valuation, show massive rebound. But even some of the financial, we saw some of the A-share fintech brokers up 88 to 89% in 5 trading sessions before the Golden Week holiday. So there was a massive rotation rally, beta rally happening. But I suspect that the beta rally stage is probably coming to an over soon. So people should reevaluate the current valuation multiple on some of these consumer property stocks and reassess whether the earnings outlook is really going to come up, turn around so quickly.
Yeah. U.S. elections are coming up, and I wonder to what extent anticipation of the result of those U.S. Elections is acting as a deterrent for any potential investors into these Chinese markets, given, again, the return of former President Trump could see an increased level of hawkishness directed at the U.S. To China. Do you think that that is one of the major obstacles that is stopping investors from piling into this market here?
For the investors we spoke to, it is a key consideration. So, if there is a change in government, there could be a lot more uncertainty, a lot more new policies coming out in January, February next year, which will disrupt the market, which will make people reassess many of the fundamentals. So people are watching the election very closely. Early November, if, the result comes out to be there's a change in government, then certainly I think market could be more risk off for China in the short term.
Yeah, geopolitics once again getting factored into markets' assessment of risk. Winnie Wu, thank you so much for joining us today. Global Research Chief China Equity Strategist at Bank of America. Thank you. Well, coming up, Kenya looks set for its first successive interest rate cut in 4 years as inflation cools. We preview today's decision next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersechi in Dubai. Well, most economists expect Kenya's central bank to cut its key interest rate for a second straight meeting today on the back of cooling inflation and the Federal Reserve's easing stance. Let's bring in Bloomberg's Ondiro Ganga, who joins us from Kigali. Well, I noted this morning that the latest inflation print came in at a 12-year low. Is that perhaps the pretext for the central bank to continue with their easing cycle?
Jumana, it's one of the reasons. Inflation fell to 3.6% from 4.4%. And this is on the lower bandwidth of the 5% that the central bank prefers to anchor inflation on. And, we can attribute this gradual downfall of inflation to a couple of things. One, favorable weather conditions. And two, government interventions through subsidies and farm inputs that has reduced the price of food and, by extension, reduced food inflation. Then the Kenyan shilling is also a big factor. The currency has been able to turn the tide, went from the worst performing currency to the best performing currency. This year alone gained over 20% against the dollar. And a couple of things have helped this shilling also. Tight monetary policy stance was very, very important in buttressing the shilling. But in August, the central bank surprised the market with a cut of 25 basis points, bringing the rate to 12.75%. And, Standard Investment Bank is saying that if you factor in low inflation, if you factor in the strong currency, it's laying ground for another cut, probably 50 basis points, which could be welcomed by the Treasury, who say it's time to make lending affordable again so that small businesses can have access to money, stimulate the economy, and create jobs.
It seems to me, though, Ondiro, because we've spoken a lot about Kenya in the last couple of months, that the politics have been driving much of the discussion here. We talked about many of the economic obstacles facing the president. We talked about the impeachment attempts for the vice president, the riots on the streets, the demonstrations, the deep revenue raising measures that the government is under a lot of pressure to achieve. Given all of this, is there any reason to believe that some of these domestic problems are improving because the central bank now has started to think about cutting interest rates?
Joanna, far from it. Today, the Deputy President is set to appear before the National Assembly for the beginning of his impeachment hearing. Yesterday, he did a really explosive televised national address where he revealed some of the inner dealings and power-sharing deals of the government that Kenyans were not privy to. He says he's going to fight till the end and he's not going to resign. This is only going to chide the political environment even further. And we need to remember that a political fallout and a bromance fallout is nothing new to President William Ruto. In the second term, when he was Vice President to Uhuru Kenyatta. They drifted far apart. They spent their last time charging the environment politically, setting the stage for the 2022 presidential election. But this time around, they don't have that privilege because already there's socio-economic tension in Kenya. They did public participation hearings, and the public was very clear. They said if the deputy president is leaving, the president should also follow suit. So they're not going to win, not in the popularity front and not in the political front.
Ondiro, thank you so much for the reporting there, and let's see what the Kenya Central Bank decides to do later. Ondiro Ganga. Now for a look at some of the other stories we're following. Uganda has delivered its first back-to-back interest rate cut in 4 years. The central bank lowered the benchmark rate yesterday by a quarter point to 9.75%. Policymakers say the decision was based on an improved inflation outlook, with the official rate falling below the 5% policy target. The Democratic Republic of Congo is planning to clamp down on companies that buy or source minerals from its war-torn eastern region. Apple has already been warned over its purchase of metals that could be linked to violence and smuggled through neighboring Rwanda. The foreign minister is calling for sanctions against Rwandan officials. Senegal's Eurobonds extended losses on Monday. That's after Moody's Ratings cut its credit rating further into junk status and placed it on watch for a further downgrade. Moody's says the decision was made after revelations the previous government's fiscal accounts were significantly weaker than previously assessed. And Zimbabwe plans to review state workers' pay after a 43% devaluation of its gold-backed currency last month that eroded their earnings. That is according to a report by the state-controlled Sunday Mail newspaper. A government minister is quoted as saying the Treasury has set aside a significant amount of US dollars to fund these salary adjustments. Coming up, we are live in Taipei, where the world's biggest iPhone assembler is set to unveil a new EV as it seeks to diversify its growth engines. More from Hon Hai's Tech Day next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Taiwanese industry giant Foxconn is holding its annual Tech Day in Taipei. The company, known formerly as Hon Hai, is the largest contract electronics maker in the world. Now it's pushing to diversify and build more future-proof income streams. Our tech reporter Annabelle Drulers joins us now from the event in Taipei. Good to have you with us. Has diversification been one of the big themes so far out of the Tech Day?
Yeah, it's really been the key theme that we've been watching here today, Jumana. I mean, if you look behind me, for instance, you can see some of the EVs, and this EV lineup has really been front and center with 2 new vehicles just being unveiled in the last couple of hours. And then off to my side as well, there's the AI Supercomputer Center 2. And we know that Hon Hai is working very closely with NVIDIA in particular, not only on the design of AI servers, but also when it comes to the manufacturing of those and the eventual rollout to the hyperscalers, AWS, Microsoft, just some of their main customers. So this is sort of what they're seeing as the next big bet for the business. It's quite interesting as well, because we really haven't heard many mentions at all even of what has been the traditional bread and butter of Hon Hai, and that's assembling consumer electronics. iPhones, for instance, it's making 2 out of the 3 of those in the world right now, but again, not the main focus of the day so far.
Yeah, it's interesting that they're making this big push into EVs now, given some of the issues facing the EV industry that we've witnessed over the last couple of months. Is there anything else that we should be watching out for out of today?
Well, I think the EVs, yeah, to your point, it is sort of interesting timing, because it's a very crowded EV market. It's coming at the time when interest rates, yes, coming down, but still elevated. So there's not really that big investment for EV startups. Some people I spoke to, for instance, said that maybe Hon Hai is trying to enter this space 5 years too late. But Hon Hai's bet is that actually, given we've got those tariff walls that are ramping up in China in particular, that this could be where its business comes into play, because they're saying there is space for that contracting model to be a viable one, given that they also say that it's going to eventually lower the costs of production. But as I said, 2 new models just unveiled. We actually heard about why they're bringing these models to the market in an exclusive interview with Jun Seki. He is the man who's leading Hon Hai's EV ambitions. Take a listen.
Model D is a D segment. It's a mix of sedan and MPVs. Very, very stylish cars. And the Model U is minibus. Those segments, we don't see a very, very strong competitor yet. And then that means we are not selling to end users. We are doing this, we call contracted design and manufacturing service to our customer. Our customer is B2C customers. So we widened their selection by those two additions.
So as we just heard there, Hon Hai is a business that's always been dealing directly with others in the business space, B2B, never B2C. They're not looking to sell these cars directly to consumers. They do still see that vision of contract manufacturing or contract manufacturing and design playing out. And they've got very ambitious targets around this space as well. They're seeing up to 45%, or that's their goal for longer term for global EV manufacturing share. But in the short term, they're still saying 5% by 2025 is possible, Joanna.
Bloomberg's tech reporter Annabelle Drewler's at the Hoi Han event, also known as Foxconn. Now, there's a lot more coming up from Hon Hai's Tech Day in Taipei. We'll be speaking live with the company chairman, Young Lu. That is at 6:30 a.m. London time. So on the show coming up right after this one in about half an hour's time. So stay tuned for that. Elsewhere, quick look at markets before we hand you off to Daybreak Europe. And it has been quite a volatile session for Asian equities overnight. Even though CSI is back on markets, we are seeing a strong day for CSI. Not such a pretty picture for Hang Seng, with that index down more than 5%. And that's lending itself to a marginally weaker session for European stocks futures. You can see that those are looking like they're going to open down 0.8%. S&P futures, Nasdaq 100 brushing off some of those concerns after a slightly negative session yesterday. Both of those indices leaning towards the green as we keep a close eye on some of the geopolitical developments coming out of the Middle East region as well. Keep a close eye also on Brent, which is trading close to $80. But that was it for Horizons Middle East and Africa. I'm Jemana Versace in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.